CNBC TV 18, celebrating 15 years of leadership.
Our top story tonight, in a significant departure from its notification issued in 2014, the Reserve Bank proposes a relaxation to the rules on call and put options, asks the government for downside protection to foreign investors upon their exit, writes to the Finance Ministry after Tata Sons moved the central bank in the Docomo matter. That's a CNBC TV 18 exclusive.
किलोमीटर के मेट्रो कॉरिडोर और 100% अंडरग्राउंड कॉरिडोर है कि जिसके माध्यम से मुंबई बहुत बड़े पैमाने पर डीकंजेस्ट होगा.
Maharashtra government plans a massive initiative to decongest Mumbai, a new coastal road, 2 underground and 1 elevated rail corridors in the making, says Chief Minister Devendra Fadnavis in an exclusive interview.
Azim Premji stands his ground, says Wipro Enterprises will not be listed. Minority shareholders also back Premji's move to take the consumer business private.
Despite lower than expected inflation and the governor's promise to cut rates outside the policy, 90% of economists don't expect a rate cut in January. That's from an exclusive CNBC TV 18 poll.
TCS rubbishes reports of large-scale layoffs as pink slips in this fiscal amounted to 0.8% of the total workforce.
What would you advise the Finance Minister to do in this budget in terms of revenue mobilization and ideas to kickstart the economy?
I would like to outsource the answer to Mr. Chitandra.
Renowned economist Jagdish Bhagwati keeps the Congress top brass in good spirits as he praises Prime Minister Narendra Modi in front of them. Says India is on the cusp of a second economic revolution and expects the Modi government to soften its stance on retail FDI.
A ray of hope for Sahara Group and Subrata Roy's US-based Mirage Group throws in a lifeline, proposes to pump in $2 billion into the cash-strapped group. That's a CNBC TV 18 exclusive.
10,000 millionaires in 2015. That's Flipkart's New Year resolution. The e-commerce giant says it hopes to help 10,000 sellers generate business worth 10 lakh rupees this year.
Volatility continues to halt the Lal Street. The Nifty slips below 8,300. The Sensex sheds 160 points despite a late recovery. Citi says Indian shares are overpriced, picks China as its best bet.
The crude carnage continues. Brent slips below $45 a mark briefly. European equities trade higher despite the oil rout on hopes of stimulus from the ECB.
Well, the Maruti 800 was the company's most iconic car. The Alto is certainly capable of giving it a run for its money. India's best-selling car for 9 years is now the world's largest-selling small car. Good evening. Thanks very much for joining us on India Business Hour. Hi, Nayantara.
Good evening, Shireen. And you know, it's not just this year. Alto has actually topped that list for, the last 3 or 4 years?
Well, it's making news tonight. And let's talk about other news that's making news tonight. Let's start off by driving into the Lal Street, where it was another choppy session. Starting with the day's trading action, the 3-day winning streak has come to an end as the Lal Street saw yet another hugely volatile session. The Nifty failing to defend the 8,300 mark, closing just shy of that level. The Sensex lost about 160 points, even after a recovery in the last few minutes of trade. Now, the mid-caps managed to end barely in the green, but all gains during the day were wiped out. Let's listen in to some of the most influential market voices.
All indications are good. I think the bull market that began, and I think it will be called the Narendra Modi bull market by historians, a year and a half ago is well and truly underway. Even in bull markets, there are very sharp corrections, there are shakeouts, and that's what we witnessed last week, I think. I think we are now entering actually a very sweet spot. Foreign flow should increase into the Indian market. I think interest rates are coming down. Market is going to focus on the budget and big bang reforms that might come with it. So I think we're going to enter a fairly sweet spot, and I think market will actually tend to do well over the next 6 months to 1 year.
The upside for the market is probably gone down a little bit from what we had anticipated earlier. Average inflation for next year, that's for FY16, should be in the region of around 5.5% or so, which would mean that if you have a real interest rate of 1.5%, you could come down to about 7%. So that means effectively a 75 to 100 basis rate cuts in FY16 is what we would expect.
There's some experts' views on where the Lal Street is headed. Here's more. Citigroup's regional strategist Marcus Rosgen says India is one of the most expensive markets in Asia. He adds it's well positioned from a rate cycle perspective, but still prefers China over India. Listen in.
So we see interest rates coming down about 100 basis points. So from a rate cycle perspective, India is well positioned. From a valuation point of view, it is one of the more expensive markets, sadly, within Asia. And so kind of near term, we think the performance is a little bit capped in terms of the upside. In terms of our outlook is probably, sort of low double-digit returns for this year. So obviously in that regard, India will do much better than Latin America or EMEA. But our strategists, for instance, in China are a lot more optimistic on the outlook for the Chinese equity market. And so in terms of China versus India, our preference would be China over India for the moment.
While different opinions coming in there, Citi believes that India looks expensive, China is the better bet, and of course big domestic voices like Ramesh Damani believe that the Modi bull market will continue to roll on. Now the big story this evening, this is a CNBC TV 18 exclusive. In a significant departure from its notification issued in 2014, the Reserve Bank of India has proposed a relaxation to the rules on call and put options. In a letter written to the Finance Ministry, the Reserve Bank has asked the government for, and I quote, downside protection to foreign investors upon their exit. The move comes after Tata Sons moved the central bank in the Docomo matter. Nantar, you've been tracking this story. Now, this is a significant departure from the Reserve Bank's stated position, which basically had stated that there should be no assured or guaranteed returns to investors, and there must be a fair market value determined at which the transaction must indeed go through. And post the representation by the Tatas in the Docomo matter, the Reserve Bank has now written to the Finance Ministry seeking a relaxation of those rules.
That's right, Shireen. In fact, this has been the stated position of the Reserve Bank for many years, which was formalized in a notification that had come out as recently as last year, where it had pretty much banned assured returns, banned minimum guarantees for agreements entered into by Indian promoters and foreign investors. So therefore, a significant departure coming in, saying that there must be a protection of downside investments, which is of course a fancy terminology for an assured return. Now this all coming after Tata Sons actually made a representation to the central bank asking if it could buy back entity Docomo's 124 crore odd shares at a predetermined rate of about 58 rupees a share. Interestingly, Tata Sons also writing in that letter that it had engaged PwC, and PwC has determined that the fair price value of each share is actually 23 rupees. Post that, as recently as 22nd of December, the Reserve Bank has written to the Finance Ministry saying larger than the assured return issue is to actually honor fair commitments that have been made in contracts, is to protect downside investment, and doesn't just stop there. Normally you perhaps would expect this to come in from the Finance Ministry, but the Reserve Bank actually writing to the Finance Ministry and saying let's also keep in view that Japan has become a strategic investor partner of India and there are large FDI inflows that are at stake. But this will not only be for Tata's and entity Docomo, Shireen. Let's be very clear about that. This is for the industry at large, because sources indicating that in that very communication, what the Reserve Bank has also written to the Finance Ministry is that this should be the new principle while determining exits, whether there are fair commitments that are in contracts, whether there is a downside investment that needs to be protected. So, of course, a significant departure. Good news for all the private equity players, foreign investors that want to exit. And once you have clarity on exits, you should have more foreign inflow. flows.
Well, let's see if that does indeed happen and whether this gets the sanction of the Finance Ministry or not. But let's go across and speak with Vivek Gupta, the partner at BMR Advisors. Vivek, appreciate you joining us. This is, of course, a CNBC TV 18 exclusive story, and we are given to understand that the Reserve Bank has reached out to the Finance Ministry seeking the Finance Ministry's views on a possible relaxation as far as the Reserve Bank's notification pertaining to assured returns are concerned. And this representation comes on the back of a proposal made by the Tatars. What do you make of this? Because this is a significant departure from the Reserve Bank's stated position, is it not?
Well, absolutely it is. So if what you're saying and what you're breaking as news is true, and the Ministry of Finance actually gives a nod to the RBI for this, then it'll certainly be very happy Lodi for capital flows. Until now, there have been two sets of views. One is that you should have either pure equity or pure debt, and equity should not be allowed to have any protection because then it starts behaving like debt. The second view has been that world over, hybrid form of capital is recognized. You can have instruments which have elements of fair market value linkage, but which have downside protection like debt. So the government, if it has moved, it would fundamentally be moving from view one, which it has consistently held over the last many years, to view two, which will be a very big move by the government. And I think what that will do is, at this point in time, we don't even realize the amount of money, the amount of contracts that private equity has had with Indian corporates, which would immediately come up and be seen in a completely different light, because these are matters which are in arbitration, where the primary defense of the Indian corporate is that Indian law restricts a payout based on downside protection, and that therefore exits can only be done at equity-based fair values. If that law were to be changed, I think it fundamentally transforms the relationship between capital providers and capital seekers in the Indian economy. It impacts a large number of current disputes. It impacts future investments in a big way, because a hybrid capital class suddenly gets created, a class which has had to be created structurally through artificial instruments up until now, but which can now legitimately, directly be created in contracting structures between Indian corporates and foreign investors. So it will certainly be a very big move.
Vivek? You know, you're saying it will be a very big move, and it is a happy Lodi for investors at this point in time if this does indeed go through. But what do you believe has changed? Because these arguments were made in the past as well by both domestic as well as foreign investors. What do you believe has moved the needle as far as the Reserve Bank is concerned? Because again, I quote to you what the Reserve Bank is saying in its letter to the Finance Ministry. The larger issue here is of a fair commitment in the contracts in relation to an investment and a downside protection of an investment rather than an assured return. In view of this, we're inclined to accept the proposal, and in future, in all such cases, the similar principle shall be applied. What do you believe has changed the central bank's mind?
So that's hard to say. What I would say is two things. Number one, what we have been seeing over the last 2 to 3 years is gradually increasing levels of confidence with the Reserve Bank of India on this very issue. So for example, from a situation where amounts were capped at an RBI formula price to a situation where it became discounted cash flow, finally it was relaxed to internationally accepted pricing method in July of 2014. We've already seen the Reserve Bank make some moves. This move, of course, will be by far the most confident of the lot. Perhaps signals a new dispensation, perhaps signals a new confidence in the way that we would interact with investors. But we might be talking about all of this very soon. From what you tell me, this is only a letter from the RBI to the Department of Economic Affairs. The government might very well take a very different stand, consistent with the past kind of stand on this issue. So one has to wait and see what actually comes out. The one other thing that I would say is there are nuances to this too. So for example, the DEA might take a conservative stand and say, while we will allow downside protection, we will not allow assured returns. So what that would mean is, so for example, in the Tata Docomo case, what I understand is they're being paid 50 cents to the dollar. So to the extent of your capital, we will protect you, but we will not allow you to pay out any interest or any sort of return on that capital. So there are various nuances, there are various permutations, combinations in the way that this policy can finally come out. But I do think that at a macro level, this signals a much more confident Reserve Bank of India, and this is not the typical protect foreign exchange kind of view, and I have for long been in favor of a more capitalistic view, allowing various forms of capital, and to me this will be net positive in the long term in terms of capital inflow.
Yeah, you're saying it will be net positive, but as you pointed out, and we're caveating that as well, this is a letter that the Reserve Bank has sent seeking comments from the Finance Ministry. We don't know the position that the Finance Ministry is going to take. But my final question to you in 10 seconds, what does your gut tell you? This is a government that is trying to woo investment, domestic as well as foreign. What does your gut tell you, Vivek? Are we likely to see, and there is the Japan angle that the Reserve Bank itself is thrown in, saying Japan is a strategic partner and hey, we may want to consider that when we take this decision. Do you believe that this is likely to go through?
So I wouldn't overemphasize the Japan angle. So I understand the Reserve Bank of India may mention it, but I wouldn't overemphasize that angle, because whatever policy the government lays out has to be judicially defensible and principally applicable to investors from all jurisdictions. So that is one. Having said that, if there was ever an opportunity in terms of sentiment, in terms of foreign exchange reserve position, in terms of confidence that regulators should have, now is the opportunity. So I do believe that the government should make some sort of forward move in this direction, even if they come up with downside protection and no assured return, etc. I still think it's a major step forward in the recognition of hybrid capital instruments. My gut is the government will go with it.
All right, Vivek, we'll have to leave it there. Appreciate you joining us. If we have any more information, we will get back to you. But thanks very much for joining us today. Nandara, what's the other corporate story?
The other big story, Shireen, coming in from Wipro Enterprises that's going private, and there are no plans to list the companies. That's a clear message coming in from Wipro's founder, Azim Premji. And that's what he told shareholders at the company's extraordinary general meeting. However, shareholders have voted on the move, and CNBC TV 18 knows the company will get the approval it needs to go private. Purnima Murli now joining us with details on that. Purnima, just a short while back, we saw a new press statement that had come out from Wipro. Take us to the details.
Well, it's now official. Wipro Enterprises Limited will not be listed, as minority shareholders also back Azim Premji's move to take the consumer business private. In a statement to CNBC TV 18, Wipro Enterprises Limited said, and I quote, "The resolution for capital reduction was passed with an overwhelming majority in the extraordinary general meeting of Wipro Enterprises Limited. However, some of the shareholders who were present in the EGM expressed that they would like to continue holding the stock. The company assured the shareholders that their sentiments will be addressed by following the due process of law." Remember, just to give you a background of what happened at the EGM today, Wipro Enterprises sought an approval from its members to reduce share capital from 492 crores to 472 crores. While Wipro promoters already hold over 96% and non-promoter shareholders hold nearly 3.4% stake in the unlisted consumer arm, this EGM was just a mere formality. In the EGM, Azim Premji made it very clear that the consumer business has a completely different structure, and hence they decided to take it private. In fact, he went on to say that Wipro Enterprises will be paying minority shareholders 367 rupees per share as a part of the squeeze-out, which is 67% more than the time of the demerger in 2012. While some of the shareholders present at the EGM today said that they are emotionally attached to the company and that they want to stay invested in the company, Premji assured them that they will inform the court that those who want to continue holding shares can do so. Now that the resolution is passed, the court approval for the reduction in share capital will come into effect. With that, it's back to you.
Right, Purnima, appreciate you joining us. That is the latest they're coming in from Wipro. Now to TCS. India's largest IT company has rubbished reports of large-scale layoffs. In a statement, TCS clarifies that only a fraction of its workforce has been reduced this fiscal. Kritika standing by with the details. Kritika, there's been a lot of rumor mongering and a lot of back and forth on whether we are going to see large retrenchment at TCS. The company finally clarifying. What does it say?
So a quick background, Shireen, to what exactly that rumour mongering was all about. There were talks that 25 to 30,000 employees at TCS had been laid off across the board. The talks had been on, or the rumours had been on for the last 1 month, and there were multiple unions that had started taking up this issue, and of course it was circulated in the social media. TCS has today broken its silence. What it does say is that they have clarified that the exits have, the involuntary attrition or involuntary exits have been as a part of their annual appraisal process. There have been no large-scale layoffs, and these claims are false and completely baseless. And what's interesting is, for the first time, in order to substantiate their statement with numbers, they have given a breakup. They have said, and we had reported this as well, that only 1% of employees have seen involuntary attrition over the last fiscal. In terms of the last 9 months, they've laid off around 2,574. And when we talk about involuntary attrition, it's not just non-performers, it's also people who are retiring that is a part of the list. They've broken up the FY14 and FY13 numbers as well. For FY14 is 2,203 and FY13 is 2,132. So much needed clarification coming in there, Shireen and Nayantara, because stock has taken a badgering over the last couple of weeks owing at the back of this news.
All right, Kritika, appreciate you joining us with those details. That's a clarification in from TCS. Now, Arvind Panagriya took charge as the Vice Chairman of the Niti Aayog, the erstwhile Planning Commission. Niti Aayog has, of course, replaced the Planning Commission. The government had notified the Cabinet resolution on this, which was approved by the Prime Minister on the 1st of January. Narendra Modi, the Prime Minister, is the Chairman of the Niti Aayog. And Panagriya's mentor and renowned economist Jagdish Bhagwati is also in the capital. He delivered the Madhavraj Sindhya Memorial Lecture in front of the entire Congress top brass, which included former Prime Minister Manmohan Singh, former Finance Minister P. Chidambaram, former Commerce Minister Anand Sharma. And he spoke with me after delivering the lecture and praised Prime Minister Modi and his attempts to transform the economy. He did say that India is on the cusp of a second economic revolution, the first being the 1991 liberalization undertaken by the former Prime Minister Manmohan Singh, and the second being the reform agenda being pushed by the Modi administration. He also believes that the Modi government will soften its stance on FDI and retail in about a year or so. Listen in to that exclusive interaction.
In 91, we carried out these reforms which really pulled people into gainful employment and really affected poverty. Finally, through high growth rates, that we now have the possibility of politicians having to compete for these things, and that leads to rewarding politicians who deliver more rather than less. So in that sense, I feel that the first revolution was critical. We are standing on the shoulders of the first revolutionaries, and now we are going to the next phase, in my opinion. And there we've got a different leadership, but that leadership, again, is something which could not have been thought of outside of the first one.
Expenditure on part of the government on healthcare is under 1.2% of GDP. We've attempted to take it to 2% of GDP. We failed over the last decade. It still is 1.2%. China at 3%. Brazil at over 4%. So India is woefully short in terms of healthcare spending. And then you promise universal health coverage to all, which will cost you about $11.4 billion annually over and above what you're already spending. And this is a right that the government of India has now promised. So don't you believe that this government continues to be in the bind that the previous government found itself in?
In my view, the real issue is not quarreling about numbers and targets and so on, but the policy part. And this is why I'm in favor of the Planning Commission, which is very target-oriented. I mean, I was a member of it in the 90s. I was not a member of it. Yes, and I think so. That has sort of gone by the board, and now we are into policy discussions. I'm glad you mentioned track 2, because this is where I think we really need to know how do we get the maximum out of it. And I think one of the problems with not redistribution, I don't like the word, but with Professor Sen is that he just assumes, at least in what he writes or says, or maybe you're misquoting him, I don't know. He doesn't write as much as I do, but so I can be hung by my own petard because my words are there. So I think he really assumes that because it's public money, it must be spent through public sector. And I think that's fundamentally a mistake.
Are you disappointed with the fact that they haven't yet opened up FDI in retail or even in e-commerce, which is really the startup sunrise sector in this country? And without doing that, will they be able to deliver on the manufacturing dream and this Make in India dream that they're holding out?
The problem with the retail sector thing is that the traditional base was the petty bourgeoisie, the small shopkeepers. And that was a part of the BJP problem in terms of making change. Now that he's got a wider constituency, and if he may be able to move, and I think whatever little conversation I had with him when he was chief minister, I never found any anti-retail sector, liberalization sentiment expressed by him. And I think so this is a matter of my forecasting, whether he will move on this. My guess, and you can, I can give you a taste of Indian wine, not foreign wine, if I lose.
You think he will open it up?
I think I would give it a year, because he will have to consolidate himself.
What is the sense that you're getting in terms of being able to get back to the 8% kind of growth rate, and what would you advise the finance minister to do in this budget in terms of revenue mobilization and ideas to kickstart the economy?
I would like to outsource the answer to Mr. Chitandra. Indian economists are generally what we call real economists. We are not financial economists. Looking at the real side and the different changes which are going to be made, there I would say that they provide the mechanism for moving faster. I think if Mr. Jaitley does manage to get moving, on the budgetary front, that will help. But it's not the main thing in my opinion. And I don't think any investment, for instance, foreign investment, is going to be held up just because the one budget doesn't do what's for you. Because people are now trying to get in on the ground floor. I mean, they realize that India is opening up because of the DF, foreign direct investment and trade, and that message is being conveyed very strongly. So they're all going to come in like hungry dogs with with their tongues hanging out and so on. So that is the great thing. And as many people, as I think Galbraith said, America's business is business, right? And so they're going to come in. They're already here. Mr. Kerry is with what? How many businessmen? And so I think that is the key part of our expansion program.
One of the harshest critics of the UPA government's economic policy, speaking in front of the entire UPA top brass about Prime Minister Narendra Modi for an hour and a half. A very interesting evening, I have to say, Nandara.
But moving on, as we celebrate 15 years of leadership, we introduce a special initiative, Indian Business Icons 2015. The endeavor is to form a distinct league of the most powerful business icons that the people of the country think have had a monumental impact not only on their lives but also in the Indian economy. An eminent jury has shortlisted 30 icons who they feel have impacted the Indian economy over the last 15 years. These names are now thrown open to all of you, the public, to vote for. The icon we're focusing on today is a stalwart from the financial sector, Aditya Puri. Take a look.
CNBC TV 18's Indian business icons, leaders, trailblazers, radicals.
He is the longest serving chief of an Indian bank. A bank he has built from scratch over 24 long years to make it India's largest private sector bank by market value. That's right, HDFC Bank is what it is today thanks to Aditya Puri's prudent approach to the financial services sector coupled with his growth-oriented leadership. But Puri's claim to fame goes beyond making HDFC Bank the colossus it is today. This former CEO of Citibank Malaysia used his 40 years of global experience to orchestrate not one, but two large mergers in the Indian banking industry. First, that of Centurion Bank of Punjab with HDFC Bank, and then of Times Bank with HDFC Bank. But this more recent accomplishment triumphs even that. Despite a challenging global economic environment, Puri has successfully removed non-performing asset from HDFC Bank's lexicon. And just for that, we think he's more than earned his place as one of India's biggest business icons.
CNBC TV 18, celebrating 15 years of leadership.